Hey, good morning, everybody, and welcome to this. What do we got today? Tuesday, June 3rd, 2025 edition of Trading Places Live at EarningsBeats.com. I'm Tom Boley, Chief Market Strategist with EarningsBeats. It's a pleasure to be with all of you again this morning. Had a nice rally yesterday in the market after being down in the morning. It was nice to see another solid AD kind of day. Of course, AD, I'm talking about the accumulation distribution line, which has been strong really throughout the last few months, couple months anyway. And prior to that, even when the market was going down, the AD lines were holding up pretty well. So in my mind, certainly provided the appearance anyway, that we had some pretty decent accumulation taking place on Wall Street, even while a lot of retail traders were panicking out of the market. And that certainly seemed to be the case once the April 7th bottom hit and we rallied back, got a lot more accumulation, or at least the appearance of accumulation in terms of that AD line just soaring. And so it's been nice to see, and I still like to see the market finish stronger in the afternoon, which is what we did yesterday. So all in all, I think things are pretty good. Got a couple of key economic reports coming out later this week having to do with jobs. And of course, that's one of the key areas. One of the uncertainties out there is whether or not the delay in cutting rates by the Fed, whether or not that's going to have some impact on the economy, on the unemployment rate. That would certainly be one thing that the Fed would watch closely. If the unemployment rate all of a sudden began to move up higher than expected, I would think that would start to put more pressure on the central bank to start to lower rates. But for right now, market seems to be hanging in there okay. Probably much better than a lot of folks would expect, given all of the uncertainties out there. But interest rates, really, they were up a little bit yesterday on the 10-year Treasury yield, but they've been hanging in, mostly just consolidating sideways. So I think that's been a good thing. The tariffs still on the table. I know a lot of folks still nervous about the tariffs and where we might go there. Inflation, even though the Fed has continued to maintain their position that we could still see a surge in inflation, we've seen absolutely no signs of that in terms of any of the economic reports. And from what I've been listening to from the Fed for the last couple of years, they keep talking about being data dependent, yet the data comes out not supporting inflation, yet they keep talking about it. So it sounds to me like they're not really looking at the data. They're looking at what they perceive could happen, which, hey, that's fine, but things could happen many different ways. Like I've said before, we could see earnings really begin to escalate. As a result, we could see the S&P 500 shoot back to 7,000 or more. That's a possibility, but they don't talk about that. They talk about all the negativity. And of course, that's what the media focuses on. Anyhow, that's not what we do here at Earnings Beats. If you've been around us for a while, we look at the charts and the charts only. I don't care what anybody is saying about anything. I don't need to know about what ifs. I need to know where the money's going. And if I see the money going in aggressive areas, I'm going to be more offensive myself. I'm going to be much more bullish about the market. And that's what I've been seeing. So anyhow, that's kind of where we are right now. So we'll jump in, take a look at some of the action that's taken place, that took place yesterday to kick off the new week and also the new month of June. Dow Jones Industrial Average finished up 35. And if you look at the chart here, this is what I was talking about. Weakness in the morning. We were down quite a bit, battled our way back, finished at the highs of the day. S&P 500 up 24 points, very similar. Weakness until about 10 o'clock yesterday morning. And then we saw buying throughout much of the day. And that was, from the low yesterday down around 58.60 to the high back above 59.35. That's 75 points. That's over 1 percentage point move in the last 6 hours of the trading day yesterday. So the S&P 500, I thought, had a really nice day. NASDAQ up 128 points, which was about 2/3 of 1%. You can see on a relative basis, NASDAQ outperforming the S&P 500 and the Dow. Seen some really good action recently in some of the Mag 7 stocks. A lot of the money is heading back into some of the large cap growth names. And I don't find that to be particularly bearish, especially if you're trading the market cap weighted indices like the S&P 500 or the NASDAQ 100, because those Mag 7 stocks are weighted pretty heavily in those indices. So you're being rewarded. S&P 400 mid cap down yesterday about 7 points, or about 1/4 of 1%. Small caps, at least based on the S&P 600, small caps down a little bit, but I tend to follow the IWM, which tracks the Russell 2000. And we actually came back up and finished green yesterday in the small cap 2000, the Russell 2000. NASDAQ 100 on the session, you can see, looking at everything other than the TSX, the NASDAQ 100 was the best performer yesterday. And again, that's going to be focused a lot more on many of the large cap tech names. So the NASDAQ 100 did well. The volatility index, the VIX, was up early in the day, was back up above 19, I believe. Let's see where we got to. Oh, actually may have touched 20. And then by the end of the day, all the way back down near the low, finishing at 1836. That was down more than 1%. And again, perhaps making another run at that 16 level. Just to refresh everyone's memory, or for those of you that are new, anytime you get the VIX down below 16 during a period where you've established a bear market, a drop of 20% or more, when you go back down, the VIX goes below 16. History tells us that the bear market is officially over. We have not seen since we've been tracking the VIX, we've not had a cyclical bear market yet where the VIX during the downtrend goes above 20 and then comes back down below 16, and then the bear market takes off again. Because bear markets require a certain amount of fear and panic in the streets. And when you get a VIX that moves back down below about that 16 level, even 17, right in there is where I think it's the threshold between, okay, we're still in an environment where maybe something could happen. I'm talking about above 16 or 17 in the VIX. Something could happen maybe to spark another sell-off. I think when you get below 16, I think the market's starting to get complacent. And remember, volatility index comes from market makers, not from, it's not like the equity only put call ratio, which is based on what retail traders are doing in the options market. The VIX is established by market makers. It's the spread, it's the expected volatility of the S&P 500 or of the S&P indices over the course of a short-term period, like 1 month. So, and market makers are pricing those options. They're the ones determining how much premium you pay when you're going to buy something that's time, where time is of the essence, like options. So I like using both of those sentiment indicators because I think the VIX gives me a little bit of an indication of what market makers are anticipating over the course of the next month, which I think is really important. But then also we can look at the equity only put call ratio that gives us a little bit better sense of what retail traders are thinking, especially the aggressive retail traders that are looking into the options world. When they get so bullish that they feel like the market cannot possibly go down, that's when the market's going to go down. And when we get really panicked and everybody's, a lot of the retail traders are playing puts as opposed to calls, and that equity only put call ratio starts to move higher, gets to certain thresholds, that's giving us a sense that options traders are very bearish and believe that the market can go only one way, which is down, and that's when the market bottoms. So those are some of the things just to keep in mind as we try to navigate the market back to new highs, which I think is where we're heading. The question in my mind is, are we going to do it in the month of June, or might it be sometime later this summer? We're certainly in an uptrend right now off of that April 7th low. So the market's got a lot of momentum, still easily could carry us up to that all-time high. But the question also is, we're overbought. We do have some sentiment issues that rear its ugly head from time to time. And so, can we navigate it now? I guess is the bigger question. But I think an uptrend is an uptrend until it isn't. So as far as I'm concerned, I'm bullish. The market's got to convince me otherwise, and not just the S&P 500, not just the major indices, but the beneath the surface signals. They need to convince me that we're going lower, and right now they're not doing a very good job of it. Sectors yesterday. Energy led yesterday. We saw the crude oil prices. I think at one point I looked and we were up 3%. So it doesn't surprise me that the XLE gained 1.3% yesterday. Technology, second best performing group, though. Communication services, the fourth best performing group. So we had some nice leadership. Discretionary did end up outperforming staples yesterday, so that ratio improved. Industrials, the only group yesterday to be down. So we had 10 out of 11 sectors higher. So we're getting that broad participation to the upside. At least we were getting it yesterday. So I think all of those things add up to a market that still wants to move higher. Can we take out the recent high on the S&P 500? That's what I'll be looking for. And looking at this chart, that level comes in at, let me annotate here. Actually, I don't want to annotate. Hit the wrong button. I want the crosshairs. So back on May the 19th, we set a high of 59.6360. And then we backed off of it. Another thing that's interesting, I'm going to point out a seasonality fact here that I don't know if you all are aware of. I know you are if you've been a EarningsBeats follower for a while. Notice the top that came back in February. Notice the date in February, the day of the month. February 19th, we topped. Just recently in May 19th, we topped. What do we talk about at EarningsBeats in terms of seasonality throughout the calendar month? The 19th to the 25th since 1950 has produced minus negative annualized returns of about 6-7% during the 19th to the 25th of all calendar months. I mean, maybe you think that's a coincidence, but that's 1 week out of the month. That's almost 25% of the calendar month has produced annualized returns of minus 6-7% since 1950. The equivalent of that, think about this. We go back, that's almost 25%, right, of the month. Well, we've had 75 years since 1950. So what's 25% of 75 years? It's roughly, what's that, 18? Almost 19. So 18 to 19 years. Let's say 18, because that'd be a little less than 25%. Imagine if I told you the next 18 years, we were going to have average annual returns of minus 7%. How excited would you be about the stock market? And yet, that's what we've been experiencing since 1950, from the 19th to the 25th. So anyway, I just happened to notice the other day that this was the 19th, and I knew we had topped on the 19th of February, just kind of underscoring this bearish historical period that we should always be aware of every single calendar month. And the reason is pretty logical in my mind. Think about when monthly options expire. It's the third Friday of every month, which could be anywhere from the 15th. If a Friday opens on the first of the month, the third Friday would be the 15th. Or if the first Friday is the 7th, which is the latest it can be, the third Friday would be the 21st. So options expire from the 15th to the 21st. And then you've got the, couple days following, you got a weekend, and then you've got a couple more days into the next week where a lot of options traders on the options expiration day will exercise. So if they've been buying and the market's been going up, and traders have a lot of in-the-money calls, they can avoid income taxes by exercising and buying the underlying stock at the strike price. And that delays taxes. So a lot of traders do exercise their options. And so the market makers are still on the other side of the trade going into the week following option expiration week. So to me, it's pretty obvious why the stock market does what it does. And just in terms of money flow and in terms of the opportunity for market makers to maybe get some money back from these options traders. So anyway, just wanted to point that out. I thought it was interesting. But now we're in the beginning of the month where inflows are coming in, that normally we've got money coming into the market. And that's why from the 26th of the month through the 6th of the following calendar month represents 83% of the S&P 500 gains since 1950. It's the portfolio managers, hedge fund managers. It's basically Wall Street at the end of a calendar month anticipating money coming in at the beginning of the month. They're front running. They're buying stocks in areas of the market where they know money is going to come into. Sounds like a pretty sound strategy to me. And historically, it's panned out. It doesn't happen every month. Please don't write in and say, well, Tom, beginning of June, we had a big drop. Okay, it happens. It's not a guarantee. It's a tendency. It's a pretty significant tendency over time. Anyhow, the question for me on the S&P 500 right now, short term, do we move back through that 59.63 level, which was the close on May 19th? If we can do that, I think we've got a really solid chance to make a push back to 61.44, which is the all-time high close back on February 19th, 61.44.15. In the meantime, this is what I was talking about earlier. See us going down. Let me get rid of these crosshairs. Here, we're going down for the 2 months. Look at the AD line just kind of hanging in there. And then as soon as we start moving back up, the AD line literally bottoms on April 7th or 8th, what looks like maybe around the 7th. And we've been going up ever since. So very clear signs of accumulation. And if you just look at the candlesticks, almost every one of them are hollow, meaning that we're closing above opens. That's bullish. If we're opening up in the morning at X, and by the end of the day, we're 0.5% or a full percent higher, wouldn't that just seem logically common sense to be accumulation? I mean, if there's a lot of selling going on, you wouldn't think prices would be ending higher. So anyhow, we've had a couple of filled candlesticks, during this period of consolidation. But again, AD line, even though we haven't broken out to a recent high, AD line soaring. So I think it looks pretty good. NASDAQ 100, pretty much same thing. Not really a whole lot to add here, except we did have a more recent candle where we had a high right here. This would have been last Thursday, where we opened at 21,611.53. We finished yesterday at 21,491. So we got about maybe 0.75% for the NASDAQ 100 or the QQQ, if you're following the ETF that tracks the NASDAQ 100. About 0.75% is going to take us back to a pretty key short-term high. If we break out again, we're back to that, February high. And in the case of the NASDAQ 100, we're talking somewhere up about the 22.2 area. If we can close back through that level, that would be very bullish for the market moving back to all-time highs. All right, small caps, IWM. This is the iShares Russell 2000. And this has been really encouraging to me because this index, the AD line, and again, the AD line is just a secondary indicator for me. It's not my primary indicator. My primary indicator is always price action. So, I can see the market was going down. I can see over here the market was going up. But the AD line, you look at it, you can't tell which was which, really. Market was going up, AD line was coming down. Market was going down, AD line was kind of, maybe going sideways. But since April 7th, everything's changed here. AD line soaring, and you can see price action doing the same. S&P 500, I wanted to show you this chart. Let's see if we can update this. And I'm going to make this chart just a little bit bigger. All right. So on this chart, what I wanted you to look at was the S&P 500. But in this case, I wanted to look at some of the sustainability ratios. And for me, that's just taking a look at aggressive areas of the market versus defensive areas. Think growth versus value. These are intermarket relationships where you can just see the rotation on the chart. And if the market's getting more bullish, if we're seeing the positive rotation in the market, like we started to see, back in early April, you can see right off these lows, we started right back up again. All of the aggressiveness, or some of the aggressiveness, was waning as we made our final high back in February. This was a warning sign. Again, the QQQ versus the spider topped all the way back in mid-December. We did make a run in the early part of February up until that February high, but we never put in a new high. If you look at the consumer discretionary versus consumer staples, this top, and let me draw some. Let's annotate this one, make it a little easier, I think. So I'm going to do these red dotted vertical lines when we get warning signs. So here was a top. So to me, QQQ versus a spider topping there is a little bit of a warning sign. The XLY, XLP topping there was a little bit of a warning sign. And the IWF, IWD, which is large cap growth versus value, topped at the end of December. So we had three sustainability ratios that were actually going down while the S&P 500 put in its final high over here. So let's put that in. Let's get this vertical line. We'll put that one in black right here. So when you look at these other charts, look at where the relationship was in terms of growth versus value at the market top. We had topped before that. Why do you think that is? Why would the large cap growth start underperforming large cap value 2 months or a month and a half before the top? What do you think? The big Wall Street firms, all that money on Wall Street's just going to sit around and just ride the market down with you and me? Of course not. They're going to get out ahead of time. Unfortunately, this is the way the stock market works. You can either start following the charts and understand what's really taking place, or you can follow the news, get brainwashed, and have the market tell you when to get out, which is usually the wrong time. And sorry if brainwashing is a strong term and offends anyone, but I think that's what happens. I think the market, you don't hear on CNBC, the analysts, I call them influencers, but the analysts go on to Wall Street and they're just talking about whatever. Does anybody else find it odd that you get, what's the guy, Mike, Morgan Stanley, guy from Morgan Stanley. Back January, February, beginning of the year, his target on the S&P 500 was 6,500. Then after the market went down, he lowered his target to 5,500. And then after the market bounced back up again, then he raised it back to 6,500. It's like, and then when it hits 6,500, CNBC will have him on and parade, have a parade on his behalf because he had a target of 6,500, rather than actually be objective and go back and say, well, you've kind of missed the boat a couple different times. Finally, I'm glad you finally got it right. That's what I would say to him. But that's not where you're going to get on CNBC. Why? How much money does Goldman Sachs pay CNBC? CBS. I don't know, but I can imagine it's quite a bit. So they're going to get on CNBC and they're going to do whatever they want to do and say whatever they want to say. Meanwhile, back at the home office, this is what they're doing. They're getting out of stocks at the top while coming on to CNBC and talking about what great, S&P 6,500, 7,000, whatever. Just throw some numbers out there. We're at all-time highs. What's not to like? Right there, February 19th, the unsuspecting public. We're at all-time high. This is great. My 401k, never been better. But they're not aware of what's taking place on the charts. So if you're wondering why back at the end of January or through the first few weeks of February, why I kept saying I was in cash and why I thought the risks in the market were too great to be in stocks, now you can look back with perfect hindsight, and now you know why. Because I'm following the charts and I'm not listening to what's going on in CBS or CNBC, whatever, anywhere for that matter. Anyhow, so where we are now is we've got the market rallying, and look at our sustainability ratios. Off that April 7th low, couldn't look better. Most of them came in. This one bottomed, the growth versus value bottomed right before the S&P 500 bottomed. This one bottomed a little after, and this one bottomed maybe just a day or two before. But look at where they are now. QQQ versus Spider sitting at a high. Discretionary versus staples has pulled back for the last couple of weeks, but I have a user-defined index that tracks how it does during the intraday, not just from day to day, which includes gaps, which can be very manipulative. I just go from 9:30 to 4 o'clock. Forget about what happens overnight, and I just start at 9:30 to 4 o'clock. And what I've seen is money rotating in a much stronger fashion toward discretionary. Although, as I mentioned yesterday, last Thursday and Friday was a little weak. And so when I look at that, and I'm going to pull that chart up next, but I just want you to see as we're going up, we're trending above the 20-day, which is now above a rising 50-day. This is bullish configuration until it's not. I mean, you can sit back and say, well, this is a false move to the upside and we're going to go right back down. I would suggest you go back and look at history, because normally when you get stocks, I'm not saying every single bear market, we've just come back up in this V pattern. We've had some that have, where we have seen some rallies, counter trend rallies, and then we go back to new lows. But signals, below the surface signals aren't pointing to any of that. And instead, what I'm looking at is markets just trending higher. So what I would just suggest is that you at least consider the fact that this is the start of a much bigger uptrend. And until we break down, I would be very, very careful going against this market. And I've been saying that for weeks now. And I think that was the right approach to this market. And it continues. Now, when we do break out, there's a very good chance we're going to have a negative divergence on the daily charts. So I think if we break out, we could make a move for 6,100, maybe for that high, but I'd be looking maybe for a reversing candle. And if we get a reversing candle with a negative divergence at major resistance, we could see a little bit more selling maybe over the summer. Maybe we go back to the 50-day at some point. That's what a negative divergence would tell me. So right now I'm bullish. I'm looking at possible scenarios where things could get a little bit murkier down the road, but ultimately long-term, we're going through 61.44. That's my belief, 100%. So long-term, what I've been telling folks who are long-term investors is just stay the course. I said that back in January and February. I said I was looking for a correction. I wasn't even looking for a cyclical bear market. I just thought we would correct, maybe a little bit of a deeper, lengthier correction while the market was going through all these uncertainties. That's kind of what I was looking for. It actually morphed into something much worse. The volatility index soared, and we had a capitulation on April 7th, big reversal, and then we started our way back up. And I think we're in an uptrend. But let me show you I want to show you this XLY, XLP chart. This is discretionary versus staples. And so here's what I was just showing you on the S&P 500 chart, the big move up, and then we pulled back, right? This is just showing it in candlestick form rather than a solid line chart. I want to take a look at this too, though, just in the last couple of days here. Look at this move yesterday. The big drop came at the opening bell. And during the day, or this was Friday, I'm sorry. And then yesterday, we had a big drop at the open early, and then we rallied back. So if you're looking at the XLY, XLP, here we were down at first half of the trading day, we were down, we rallied back. Then the first 30 minutes, could even go out 90 minutes or so, we had a little bit of a rough start as far as discretionary versus staples. But then we rallied back again late in the day. So, I mean, I'm looking at this from a longer term perspective and thinking, we could take a look at the monthly. We had this huge move up. We could even go back a couple of months, go back closer to that April 7th bottom. And you can see where we were back on April 21st. And look at that move to the upside. It's just like a stock. It's okay to have a little bit of a pullback to consolidate for a period of time. But if we turn back up on this, this is definitely a ratio I'd watch really closely, especially if you're bearish. If you're bearish, there's no reason why money should start pouring back into discretionary stocks from this level. So I would just caution you about being bearish, especially if this ratio starts to move back up again. Something I just keep an eye on. All right, for those of you that are new to EarningsBeats, maybe new to the show here on YouTube, welcome. We always love to build our community here. The way we do that is by getting folks like you to click that like button for us and to subscribe to our channel at YouTube. So please do that. Even if you can't become a subscriber, a paid subscriber at EarningsBeats, you can really help us by helping us build our YouTube community and trying to reach more folks out there. So please do that if you can. If you'd like to try our service, we have a 30-day no-cost trial. 30 days free. You have to give a credit card. But before your 30 days are up, we will reach out to you for a couple reasons. Number one, to let you know that your trial is expiring and you need to do something or you're going to get charged a monthly fee. So we will tell you ahead of time. Also, if you like our service, we're going to give you one heck of a discount that'll probably save you 50% off of the monthly cost. So we try to, we're as ethical as can be. We're going to let you know when you're coming up on your 30-day trial expiration. And because we don't want you to pay if you're not interested in being a member. If what we do doesn't interest you, whether it's our market guidance, which I think has been impeccable, our market education, which we've been doing now, I don't know how many people we've had that we've educated over the last 21 years, which is how long we've been in business now. But we're into the tens of thousands of folks. So if you don't want market guidance, market education, and how about market research, our own independent research, rather than listen to regurgitated information on social media? Many times folks don't even research. They just post it because they've seen it somewhere. We do independent research. I don't put claims out there about the stock market unless I've done the research on it. Anyhow, check that out. If you just want to get to know us a little bit better, we have a free newsletter. No credit card required. We've had tens of thousands of folks subscribe to this. Name and email address, all it takes. We come out with our articles Monday and Wednesday. Yesterday, we had a giveaway. Our giveaway was basically a new chart list that we were featuring, where we take a look at the leading stocks and leading industry groups. We have our own formula and scan syntax that we use in order to come up with those stocks. We're going to do that on a weekly basis. So yesterday we gave out I think there were 43 stocks that we put out on this list. We think it's 43 of the best stocks out there to consider trading if you're a momentum trader. All you had to do was be a free member on Monday, and we sent that to you. If you are a member tomorrow morning, and I'm just talking about an EB Digest subscriber, a free subscriber, if you are on this tomorrow morning, we will repost that link again so you can check that out. But we're going to be doing this for our members going forward, week after week after week. So I think it's a great reason to subscribe. Check out that list. Look at some of the things that are important to us in terms of momentum trading, and I think it'll improve your results. Last thing I wanted to do before we wrap up, I know the market's just opened. I wanted to check out just a couple of the aggressive sectors just to see where they stand in terms of their current technical outlook. Here's technology, beautiful move up, sideways consolidating like a little flag pattern. I think as long as we hold up between gap support from 217 to about this support area around 225, I think that, and I'm talking more intermediate. Short term, I'd probably watch 225. Intermediate, I think you could go down as low as this 217 area. That's kind of where we broke out above this reaction high late in March. And it's also where we have gap support. And notice the 50 days coming up right underneath there now. Right now it's at 213. So you're getting a lot of support down closer to that 217 level. The next chart I wanted to show you, and I'm just going to do the three aggressive, XLK, XLY, XLC, because these are the three that if the market's going to keep going up, these are the three that market needs to go up with it. XLY, beautiful move off the bottom, kind of the same type of chart. Watch around 209 to the downside. And then if things were to get a little worse, maybe we're looking at 203, 202 and a half gap support with that 50-day coming up underneath right now at 200.88. So pretty close to that 202.50 to 203 area. To the upside, we got a double top, get through 219, and looks like consumer discretionary will be off to the races again. And then the last one I wanted to show you, and then we'll wrap up here. XLC, again, beautiful move to the upside, and then we go sideways, in a flag pattern here for the last couple of weeks. Looks to me like a bull flag, ready to make a breakout. And if it does, I think that 105 level will come into play pretty quickly. But watch also the relative resistance levels. When the XLC breaks out up here on an absolute basis, check down, see if it's breaking out on a relative basis as well. If it is, that really adds to the bullishness of the move. All right, let's take a quick look at the indices, see where we are right now. We got the Dow up 24, S&P down 3, NASDAQ down 4, NASDAQ 100 down 5. Got small caps showing down, but that's not always what the IWM is. Let's see what the IWM is up slightly, up 0.15%. So we're mostly flat right now. I'm paying a lot more attention, though, to what goes on during the trading day. So let's see how we finish and whether or not we continue to hold on to rising 20-day EMAs. I think that's going to be critical. Again, jobs coming out. We got ADP employment report tomorrow. We got the non-farm payrolls report on Friday. And I think that those are both market moving kinds of reports, especially the Friday non-farm payrolls, where we'll get the latest on unemployment. Have a great day, everybody. And I'll be back next Tuesday for the next Trading Places Live. Happy trading.